So there's a little known secret in the real estate investing world, which is self-directed IRAs and the potential of using a self-directed IRA for real estate investing. And I actually learned this from you, Brett. You shared this with me. And I have a little interesting story of me trying to deploy this. But before we jump into that, maybe sharing or explain what is a self-directed IRA?
All right. Hey, yeah, great question. Welcome everybody to the show. Great to have you listening, and thanks for doing the listening, whether it's a download or straight direct listening. Yeah, where does this start? I mean, there's so much more. First of all, again, I just want to let everybody know, full transparency, I'm not a certified public accountant. I have not researched all of this. I only share my experience in this stuff. I'm sure a lot of listeners are aware of the different ways that we're incentivized by employers when it comes to tax advantageous mechanisms, right? There's a lot of words to make it, hey, you don't have to pay taxes on this. There's a different way of doing it. And whether or not it was, the tax code changing to pull weight off the Social Security platform and allowing us to invest ourselves instead of depend on that piece. So there's a way now that there's different mechanisms and that allow us to invest ourselves as opposed to depending on the government to do it. And they incentivize us to do this through the advantages of the tax code. It's not an advantage if you don't know what it is, right? It's not an advantage if you don't take advantage of it. So there's lots of pieces that roll into this. Now you'll see these things with, typically three numbers up front and a letter following. It's definitely the 401k. I think it's 403b. Was it 402c? Again, I apologize. I don't know all the letters for these things, but I know everybody out there has one or two of these things because that's how we're incentivized. The thing is, they often go into a portfolio manager that's provided by the employer. So we don't ever have to worry about this. We've always been told or taught it's a set and forget kind of thing. A lot of time you go into a mutual fund, sometimes into ETFs and those kind of things where it's a set and forget, and you're totally reliant on the portfolio manager who has assets under management and the market itself. So we just forget these things. What we don't realize or understand is that we have the ability to control these through a mechanism called self-control. And this even goes for the Roth. Now, Roth typically is for, outside of employment. And being self-employed for so long, business owner for so long, that's something that I've focused on, laser focused on a lot in the past years is my Roth. I've built my Roth up. Now I have self-directed Roth IRA. So just looking at the IRAs themselves, there's standard versus Roth, and it's the way that the money's taxed. Standard IRA is you're not taxed until you disperse, right? Once you take it out, that's when you're taxed. And the idea is that it's going to grow faster. If you have more money in there, it's going to grow faster, compounding interest, right? And the other idea with the Roth is it's already taxed before it's in. So it's what you call tax dollars, and the standard is the pre-tax dollars. I have Roth IRA, self-directed Roth IRA. And that means that money that I'm building in there, when I take disbursements from that, I will never have to pay a single cent in taxes as long as that mechanism is working. So I really like that. There's two simple ways of looking at those standard and Roth, Thomas. Like I said, I don't know the numbers on the other ones, 401k type things. And there's just different ways of doing it. Ultimately, it's an incentive for us to invest our money for retirement. Does that make sense?
Yeah, it does make sense.
I didn't slaughter it, did I?
No, I don't think so. Okay. I think you explained that very well. And the self-directed, because what you were describing was they're all managed and they put your money into these funds that typically will give you like very conservative. They're more for security.
Not self-directed. You can do self-directed that are managed by other funds, but typically when I see, especially real estate investors, when you start a self-directed Roth IRA or a self-directed IRA, self-directed 401k, you are directing it yourself, Do
Right.
you pull it out of these funds? You pull it out of Oppenheimer, you pull it out of Wells Fargo, and you now have a custodian who sees outside of the box. There are limitations that we could talk about here, but you're outside of the box now. And I'm really excited to share my stories on where we're at as a family, and see where we've gone, and some of my colleagues where they've gone. But before we got there, tell me a little bit about being stuck in the box. Thomas, you had done some research about your parents, and getting their, I believe it was 401ks, right, rolled over into a self-directed custodian or a self-directed account. That way you create an LLC, and then you have checkbook control over that LLC. So you can literally write checks from your accounts.
Yeah.
So tell us a little bit about that experience that you had.
Yeah. Well, like I mentioned at the beginning of the episode, a little known secret. And I think this is hilarious because this person that is managing my parents' retirement accounts is a financial advisor. That's what he does. It's his profession. So you'd expect him to know about all these different things, all these different options. And to be honest, I'm not sure if he didn't know, or maybe he did and he just didn't want us to do it, maybe because he was incentivized to keep the funds under his own. Whatever the case may be, I reached out. I was having a conversation with my parents. I wanted to invest in real estate, and to do that, I needed money, and I knew my parents had a decent amount in their retirement accounts. We've built up trust with each other. We have a good relationship. So I knew that they'd be willing to allow me to use their retirement money to purchase and do value add real estate for single family. So I talked to them about it. I got the contact information to their financial advisor and called them up and had a conversation and told them exactly what I wanted to do, which is what we're talking about now. Is I want to move over the money, put it into a self-directed IRA so that I can purchase real estate. And he just simply told me that's not possible. Mm-hmm. It's like
asking the directions how to get somewhere, and somebody say you can't get there from here.
Yeah. So I was like, okay, well, it is possible, but I didn't want to get into an argument with someone who, he has the authority, I guess you could say, of being a financial advisor to support us, being a superior or whatever. And so I just that conversation ended very quickly. But I thought that was very interesting because we both know it is possible and you've done it yourself. And meanwhile, our financial advisor is telling us that it's not possible.
Yep. So one thing that jumped out to me is when you do self-directed, there are certain stipulations and restrictions that you have to watch out for. One of them, I believe, is the arm's length rule, and how you can lend money from one person to another person. Some of these other stipulations will also say that you can't be on a property, you can't swing a hammer. It's very restrictive on what you can do, who you can loan to. So beside that, though, you can't get there from here, because if you think about it, I don't know of many financial advisors who are incentivized to invest in real estate, invest in control in real estate. I'm not talking about a REIT, a real estate investment trust. I'm not talking about the funds that deal directly with acquiring real. I'm talking about owning and controlling real estate, and even lending to real estate investors, because that's something that we do too with these self-directed accounts. Is I can now use my money and lend it to other investors. You've got to have good relationships with these investors, good trust with them, but you can have some massive returns doing this. So that big piece is something to keep in mind. Incentivized versus disincentivized. And when a financial advisor has your money in their portfolio as assets under management, and depending on which financial advisor it would be, and again, I'm not a financial advisor. I don't know. This never worked as a financial advisor. Just my experience being around them and being with them. You get incentivized for having money, having assets under management, And some even get incentivized for doing well for the clients as well too. But none of them are incentivized for them telling you that they should take their money elsewhere, right? And that's basically what you're doing when you roll over. You're not taking a disbursement. It's not a taxable event. You're rolling it over into a new custodian. So two things to look at here is the custodian and we'll call it consultant. Consultant is going to be somebody who can set up the LLCs for you, can tell you what custodian to work with, charge you a fee, do all the paperwork for you. And then the custodian is the one who actually holds the accounts. So there's two different ways. The first time that we set these up, Thomas, we used, say the consultants, right? The companies that showed us when and what to do, what we couldn't do, those kind of things. So there's a couple of different places out there that would do it. We originally started with a company called NCH, Nevada Corporate Headquarters. They were the most expensive, but they were the most turnkey. And we had set these companies up to where it was a self-directed, and mine was a self-directed Roth IRA, because I had rolled over my Roth that I had been maxing out year after year after year, and now I have checkbook control over it. So I roll it over. I used NCH. We have a custodian to do this, and I'm all set. I have my rules and regulations. I have my LLC. I have my bank account. I have checkbook control over my Roth IRA. And through that, Thomas, you've seen us lend to other investors. We've flipped houses in it very sparingly. I would say one a year. And now we currently own real estate with it as well too. And yeah. I seriously, like when I was a carpenter, right? I was early on in my career, starting a construction company or whatever. I was maybe lucky if I put $200 into that thing for the entire year, right? Now at this point, maxing it out completely, but I literally doubled that Roth IRA in, I believe, 2 years. That's remarkable. And I'm pushing it past the 6-figure mark. I'm watching that. I mean, it was like celebratory. It was awesome. And it was all done through self-directed in the asset class of real estate.
Yeah. And speaking of lending to other people, you actually, either it was you or your wife, Erin, who lent money from a self-directed IRA to myself to purchase a property. And you were getting returns on that money, probably just as good, if not potentially better than what you would have had if you had it in a non-self-directed in some sort of fund or whatever that was. Believe It was like 10%. And of course, when you do this, you can decide the terms yourself with whoever you're lending that money to.
And yeah, as a lender, that's absolutely right. And as a lender, I evaluate the deal based on my risk tolerance. If I'm working with a newer flipper, doesn't have a lot of experience, then I'm going to be more what's called a hard money lender. I'm going to be maxing out my interest rate. I'm going to be charging points. I'm going to be charging, I'm not going to give them all the money up front. They need to have skin in the game. We're going to do draws. I need to make sure that work is getting done. So I'm there's pieces of that mitigates risk in that process. Yeah.
Because I believe we did 10% and some points. Because that was my first time. Of course, I had your assistance, resources, and all that sort of thing to help out with it. But it's a very interesting way, creative way that very few people know about. So all this sounds very interesting. And if someone wants to do it, what are the steps they have to take in order to go ahead and set
I think just first of all, being aware of the restrictions. Like even on that one, even though I lent you the money, I didn't give you anything. I didn't give you the tools to do the job. I didn't make any of the repairs myself. So that you have to know what to do and what not to do is the biggest piece. And not knowing every single piece, but just being honest with yourself. That piece of integrity is massive. Making sure that everything you do is without question. But in order to do that, you have to have somebody to talk to. And I called it a consultant. The company that we use on some of these other ones called it's Madison Trust, I believe. I believe it's Madison Trust. I don't think they're the custodian. Yeah, I'd have to look up the custodian then. But if you get with the first company who then gives you to the custodian, that way you know who you're working with, and then they'll give you the ins and outs of what you need to do. You can always do research yourself too, you know?
Yeah, I mean, pull up Google and type in self-directed IRA, help setting up self-directed IRA, and I'm sure there'll be a million results within a couple seconds.
Yeah, I also know an investor, and actually be cool to get him on the show, who is a hard money lender, and him and his father both had set these up, and for a total of, I think they spent like less than $100 setting up the entire thing, the custodian, the LLC, everything, you know, but his risk tolerance is, I guess, higher in that point because he's the only one to blame if something goes wrong, you know?
Right. Yeah, it must, and also more knowledgeable in the area if he's doing it most of the stuff himself.
Okay, so I checked on this briefly. Sorry about that. So Broad Financial is the consultant on this, and then Madison Trust is the, geez, I just can't even remember what I called it before. What's that?
You say consultant or custodian or
custodian? Yeah.
Custodian.
Geez, I got the one thing out and it squeezed it. I only have so much room in my brain, Thomas. There's only so many words that can be in there at one time, and then the other ones go out my ears. So Broad Financial is the consultant telling us, hey, you can do this. We'll set this up. We'll give you the operating agreement. We do all of this stuff. And then Madison Trust is the custodian. So they're the ones that actually hold the money. I fill out all the paperwork through them. That's where it's at. They then fund my LLC that I've created on behalf of the Roth IRA. So the Roth IRA, for benefit of Brett Riggins, now has funded this LLC, basically an investor in this LLC. I'm the manager of this LLC, gives me checkbook control of that. So that started with Broad Financial. Everybody can check them out. And then the custodian then is Madison Trust. And that's who I'm working with currently because they're the custodian. Okay. Another company that we use is called Equity Trust. And I selected Equity Trust for a couple of our investors who maybe a little less hands-on as far as paperwork goes. They're a little more difficult to work with, hoops to jump through, because it's not a checkbook control situation where they're actually holding the money, the assets, and you've got to go through certain ways to withdraw, certain ways to pay, certain way to accept payment. So it's, if your risk tolerance is lower, I would say go with Equity Trust. And you can do, whether it's a rollover into a self-directed IRA, 401k, Roth, all of that stuff, they handle all of this. And they will actually allow you to invest in, help you invest in mutual funds still that way too. So say you're waiting for a deal to come up, you can still invest your money into mutual funds through them. Yeah.
Okay. And you said that you currently own real estate from your self-directed, which if anyone listening, I mean, that sounds pretty cool. I'd like to do that. So what are the things that you can do and can't do, and how can someone do that themselves if, say, they have $500,000 right now and they in their retirement and they are like, well, I want to, start acquiring real estate.
Yeah. First I would ask, where are you at in your life first? Because you really have to decide, is this something that I want to do? Does it match with my goals? Does it match with my why? Because if you're in self-directed, if you already have that money in there and you can roll it over, that's great. And if you're looking at investing to have money now, this is not going to be the answer, right? So we use these tax advantageous mechanisms for further down the road. For me, that's still a ways out. For you, that's a really long ways out. So basically you are doing this for retirement purposes. That's the first piece.
Yeah.
The second piece is you have to assess what your risk tolerance is, how much time you have. And you go into it the way of, I don't have a lot of time. I don't have time to track paperwork or to learn. Then you probably want to go with more of a turnkey outfit. And that's like that Nevada corporate headquarters. They're great. They're really expensive. They're good at what they do. Nevada is actually an expensive state to incorporate in. That's where they do all their incorporating from. So you can do something like that, which is completely turnkey. I can be Chuck in a truck and green behind the ears and not know anything. I can be comfortable with an outfit like that because they have attorneys, consultants, accountants, all of that stuff on staff. Similar, maybe one step down then would be equity trust, and reaching out to them and having a discussion with their sales department and saying, what kind of account are you looking to roll over, first of all? And then what are you looking to do with it? So some things that you could do with it could be investing in other investors. It could be acquiring real estate directly. You can invest that into syndications. I mean, there's certain things that you can do that allow you to take control of your money. Ultimately, what you can and can't do really depends on the type of necessarily exit strategy, but the type of investing that you're doing. If you have a tangible asset, you can't be on site. You can't do any of the work yourself. If there's a swimming pool on this place, you can't even enjoy the swimming pool. You can't reap any of the benefits of the asset, if that makes sense. So you've got to paper trail everything. We tell everybody, track often and track a lot, right? So same way, I can't have cash exchanging hands. I can't, I've got to have paper trails for everybody, and I've got to hire everything out.
Yeah.
Even
best to work with a professional who knows and can and tell you what you should
even
do.
For me, like when I mentioned that to you, even I don't know all the ins and outs of it, but I'm going to do things above and beyond to make sure that I know inside my heart that I've done the right thing. And it even comes down to, I'll go and buy pre-stamped envelopes, maybe 10 or 20 of them. That way, when I need to mail something for that company, I know that I've already bought the stamp. And remember, how much does a stamp cost? How much does an envelope cost? I'm talking, those are the things that I know that I'm doing the right thing when I take steps like that. So we talked about Nevada corporate headquarters, equity trust, and then into Madison, where I'm doing a little more myself. Broad financial. I'm doing a little more myself. And then that last one, Thomas, was the fellow investor that I knew that set it up himself completely. Like, you don't need any special training. There's nothing special about this. You need a custodian, and you need an LLC and a checking account. And those things have to be set up right. There are some things you need to know. But if you have those, you don't have to have anybody else to get there. I was just was thinking something else along those lines too, of setting it up yourself, but escaped my mind. Now there's different benefits in each one of those too. Like in my Roth IRA, I can't leverage money the same way that I can in a standard Roth. It's a taxable event. I believe when I leverage money in a Roth versus leveraging in the standard IRA or the 401k. And how we can leverage in the 401k, the solo K, is we can take a non-recourse loan and we can leverage up to 50% of the value of the property inside of these self-directed accounts. Now we're getting back into the benefits of real estate, right? Mm-hmm. This is huge. So if you're setting up a company, and we've talked a little bit about this, Thomas, too, the S-elect on a company, right? On an LLC of an S-elect. So now I can create this LLC as an S-elect. I can set up what's called a solo K. And it's remarkable how much money that you can put into these things for the year. Obviously, you have to make money to do this, and you have to, typically you're going to do this in, I believe, where you're the only employee of that company, but somebody has to pull this number for me. I'm thinking is close to like $150 a year that you can put into these things.
Oh, wow.
And I'm not sure if that might be for married couples. But at that amount, 150, you can put this into these mechanisms, into these vehicles. And now inside of this, I can leverage. So I say I've got 100,000 in there. I'm going to buy a $100,000 house. Now I can buy two because I can get 50% non-recourse, which means there's nothing that the bank can come against except for the property on these. And now I've got two properties. Now I'm leveraging the benefits of using real estate as an investment vehicle.
Yeah.
That's huge.
awesome.
There's another downfall here though, is that limitation on leverage for one particular. Now, this is different too. Like you can talk to one person, oh yeah, I know this. Yeah, you can do this. And then the next person you talk to, oh yeah, you can't do that, but you can do this. This feels like that's a downfall in it. There's not enough, I guess maybe that's something in me. I don't have enough people around me that know this kind of outside of the box investing to be firm and accurate on every single thing. Cause it feels like they're like elbows. Everybody's got opinions, everybody's got them. That's a downfall of it. The way to leverage the Roth versus the standard is different. You can't leverage as much. That knowledge piece I talked about. I think that the leverage piece is the biggest downfall. And you can't say if something were to fall apart in the real estate world where we have value add. I do have that last resort of, putting in the sweat equity and finishing it. You don't have that opportunity here. And when your money runs out, it's out. I can't add anywhere else. So if I get down to the bottom of my investment, say I've got something at 80K and I need $1,000 to save it, I don't have $1,000, right? I can't do anything about it. I'm done.
So it's only money from that account. You can't increase it.
No. I can increase it every year through my contributions, in which we do 5,500 or 6,000. I think it's up to 6,000 now. So we'll contribute every single year, and I can increase it.
Okay, yeah, but then you'd have to hold on to it, and by then it's probably a little late.
Yep. Let me kind of on the backside of this. I kind of jumped all over. I missed some words. I do apologize for that, and I think I got the general idea out there. But the one last thing I want to add, Thomas, is a hypothetical. And this is very interesting. If you have that, so you have an LLC, if you have the S Corp, the S Elect, you now have employees to pay, and you have a family business, you can now pay your children for the things that they do in the business. Now, just saying hypothetically, say your children are able to do marketing, maybe do social media, maybe do some marketing is a big piece, some minor things, What's that?
They could do some modeling for
photos. You're not getting against, I've had people, I get so emotional about this topic. It's fascinating. This is not child labor. You know what I mean? This is nothing like it. It's that you have the ability to do this. You can pay your child in a family business, right? This is interesting. If you were to set this up so you pay your children, say the max contribution level, the 5,500 or the 6,000 a year, they can start investing in their Roth as early as they want. So they can take this money that they're making and invest into a Roth, right? So now instead of paying them, why do they need $6,000 a year first? They don't, right? So we can take this, we can pay them, and we can move that money into the Roth, and they start building the Roth. The game changer in life, in wealth generation, comes with ideas like this, because if you look at, let's take, what is the amount? Like $50,000. Boy, I should really know this. If you took $25,000 and you looked at the effects of compounding interest, right? Let's take this and grow it at 12%, 25,000 at 12%. And by the time that they start drawing on this Roth, which is in their 50s, do you have any idea what the value of that money is? In 12% in real estate, you better be getting at least 12% in real estate, right? So would you have the value of this money by the time they're in their 50s?
I don't know what the number is, but I know that it's a very, very, very big number.
Yes. I believe, again, these are one of these things, somebody can fact check me on this. I believe it's over $20 million.
Oh, yeah. Yeah.
So now let's take another look at this. Remember, we said it's a Roth. Say it's self-directed Roth IRA. Remember, Roth is already been taxed. They got taxed they got taxed their employment tax, right? Their income tax on this money. So we pay them just over the amount for them to net their max contribution. That way they can max out their contribution. And now they're set. They've got this money that's growing. By the time it hits $25,000, it grows at 12% compounding interest. You look at setting them up in the millions tax-free by the time they retire, right? Then we stumble into a whole nother world of, do you really want to set your children up like that?
Yeah, that's a whole nother conversation. Yeah.
But these are all the things that are outside of the box, right? And I know there's a lot of physicians who are out there who I know you've had these conversations. I know I'm not a physician. I don't spend my life in the hospital. I do speak with a lot of physicians. I know you've had this conversation. We should invest in real estate. Everybody knows we should invest in real estate. I'm looking at my 401ks, 403B, 402C. I think that's the other one. And if I keep pounding this in there, now I'm 10 years out, I've got to put another 10 years in, and I want to be done. Now, if I keep up at this pace, I'm not going to outpace my income, which means I'm going to be trading time for money.
Yeah.
These outside of the box mechanisms and strategies are what make the difference, right? And then they put us in another challenge, more of a moral and ethical challenge. Is now I'm not teaching my children how to make money. I'm teaching them how to be good people.
Right. Yeah. Teaching character.
Yep.
Absolutely. Principles. Yep. Well, that's quite a lot in this short episode here. A lot to do, and yeah, I think
call the fact checkers on that one.
Professionals are definitely needed for when you're going to do this, unless you really want to dive into it and get into all the legality and different details yourself. But for most, it's probably worth paying someone to help you.
Yep. Start with a turnkey. You can work yourself out of it into a less involved outfit. But if you find somebody who puts together the LLC, the operating agreements, the articles of incorporation, line you up on what you need and what you don't need, and then connect you with the custodian, that's the safest way. But remember, you don't need any of that stuff to actually do it either.
Yeah, that's right. Well, I think that's a good place to end this episode. Brett, thank you everyone for listening. And be sure if you guys have questions, you're able to reach out to us at our website.
Yep, the website is
physicianwealthsystems.com.
physicianwealthsystems.com. Perfect. All right, man. Well, thanks for joining us for the conversation today, and we'll see all you next time.